Welcome everybody. Great to see you all joining for this important webinar. Please say, how's it in the chat? Let us know who you are, where you work, all the details that you're happy to part with. I'm sure you've joined CFO webinars more often, so you know it's all about engagement. You probably also know that I'm supposed to have a slide up by now, which I don't. So you can comment on that in the chat as well. But here's the slide. This is the webinar that we are about to commence, and we're just waiting for a few more people to join. But yeah, let me start the official welcome. Smart finance for imports and exports. How to use export credit financing structures to diversify your business revenue. We're very fortunate this morning to have Craig White, Principal Export Credit Finance at Nedbank CIB. Nedbank really has been a phenomenal supporter of the CFO community, coming with lots of great practical content on our webinars this year. So once again, a super relevant topic. So super grateful to have Craig on this morning. Just to set your expectations, you'll start about some advice and tips around growing your revenue to smart export finance solutions, and especially through an agency that'll explain everything about. And then after that, you'll look a little bit at importing as well. But we really want to make it very interactive, so I'll put a few polls up while Craig is talking that sort of speak to his presentation. And also, please just ask as many questions as possible. There's, let me say, barely any stupid questions, so please bring it. So this is the moment that I'm going to jump off camera. I'm going to stop this slide presentation and start Craig's one. And I'm going to welcome you once again, Craig, and thanks for joining us, and looking forward to learning from you.
Yeah, thank you very much, Joel. And ladies and gentlemen, a very, very good morning to all of you. I trust you're all doing well despite the circumstances, and really looking forward to our session this morning, where we'll be looking at some of the nuances of exporting and importing, but specifically looking at financing structures that can help you unlock your exports, but also your imports. As Joel mentioned, my name is Craig Waits. I'm a principal in Nedbank's export credit finance team, and we really specialize in providing export credit agency supported financing. And really the purpose of this presentation this morning will be to go through some of the nuances of that product and to really demonstrate how it can unlock value for your business. So I think without any further delay, let's jump straight into it. And before we get into the specifics, just a brief outline of the presentation that we'll be giving this morning. Excuse me. Firstly, we'll be looking at the challenges of exporting and importing at present. Now, ladies and gentlemen, as a banker, we regularly speaking to our clients, and the challenges, especially in the current environment, there are significant challenges. Obviously, COVID-19 has had a detrimental effect on markets, especially emerging markets, and the challenges are extraordinary at the moment. So we'll be looking at some of those challenges and seeing how export credit agency financing can assist in unlocking those challenges and mitigating them somewhat. Thereafter, we'll look at a specific solution for exporting, which we think would be very interesting for any South African company. We'll then look at solutions for importing as well. And then hopefully we'll have enough time to take any questions and comments and have a little bit of a debate over the merits of export credit agency financing. So moving along, as I mentioned earlier, we regularly speaking to our clients, and we really want to understand what their challenges are in the current market, because I think as bankers, what we're trying to do, we're trying to find solutions. We're trying to unlock value. And when we talk to our clients that are looking to export to various parts of the world, predominantly South African companies are looking to export into the rest of the African continent. What are we hearing? The message, I must say, is quite consistent. It's the same thing over and over again. And that message is as follows. You have a client, but your client wants you to extend very lengthy payment terms. In other words, they can't pay you within 30 days or 60 days. They're looking for 360-day payment terms, if not longer. And obviously that has a material impact for your business because there's a cash flow consideration there. The second point that we're hearing over and over again is that your clients, your buyer, doesn't have access to financing from their domestic bank. And obviously, if they can't raise financing, they can't pay you. So again, a significant problem. The third point that we're hearing very regularly is that your client wants to pay you, but they only have access to their domestic currency. So for example, very recently, I spoke to a client who was looking to export from South Africa into Angola. Their Angolan clients only had access to Angolan Kwanza. Now, for a South African company to be paid in a currency like the Kwanza is not always ideal because at the end of the day, you're the one taking the conversion risk, as well as any volatility of that currency versus, say, the US dollar or even the rand for that matter. So from an export point of view, I think the feedback from our clients is quite consistent. These are really the three big issues that exporters are facing at this stage. On the importing side, so if we take, say, a South African company that's looking to import into South Africa, we're hearing the following, that the seller, so that's the international seller, wants you to pay the full amount upfront. And again, there's a cash flow consideration there. The second point is that when you go to your local bank and look for unsecured financing, your local bank is not always prepared to give you that financing. And there's various reasons, but the reason that we find comes up time and time again is that your local bank is often outside of their limits. It goes without saying that every bank has limits in place for their clients, and if they don't have sufficient limits to provide you with additional financing, this is often a problem. The third point that we're hearing more and more is that your local bank might be prepared to provide you with the financing, but the interest rate is unattractive. And obviously, if you are looking to, say, import, let's say it's a bespoke piece of equipment because you're looking to initiate a new line of revenue within your business, that interest rate, that debt service is particularly key, because if it's not attractive, it can obviously have an impact on the success of the initiative that you're trying to launch. So ladies and gentlemen, in general, these are some of the points that our clients are telling us, the challenges of both exporting and importing. Well, the good news is that we potentially have a solution to mitigate some of these problems. Now, obviously, I touched earlier on the impact of COVID-19, and I think to give you some insights into what we as the banking community are seeing, obviously our non-performing loan book has increased quite significantly. For anyone that followed the half-year results of the South African banks, you would have seen that the non-performing loans or credit loss ratios more or less doubled in the 6 months to June of 2020. And it obviously speaks to the impact that COVID-19 has had on the domestic economy. Obviously, as a result of that, there's greater conservatism in terms of lending. Banks are more conservative in terms of providing debt financing because they're obviously aware of the challenges in the current market. What we're also hearing from our clients is that generally there's a reluctance for banks to bank new clients. And again, what we're seeing at the moment is there's a certain flight to quality. In other words, banks would rather bank their existing client base rather than taking on a new client with all the uncertainty that goes with that. So, ladies and gentlemen, really the purpose of this presentation today is to give you some solutions, something that you can take away, something that you can explore in the best interest of unlocking your exports and imports. So let's jump straight into it. And I think the logical starting point for any discussion on export credit agency financing is to answer this key question, well, what is an export credit agency? Well, as we've defined there in the presentation, an export credit agency is effectively a governmental agency whose mandate is to support the export of locally manufactured goods to foreign markets. And they do so in the interest of job creation, economic growth, and local development. Now, to give you a little bit of a history lesson on export credit agencies, it's considered within the export credit agency market that the very first export credit agency was the Export Credit Agency of the United Kingdom. And the reason why the United Kingdom started their export credit agency, and I believe it was as far back as the year 1919, so over 100 years old, was that in the post-World War I environment, there was a lot of developments that needed to happen. And the UK government felt that the only way that they could develop their local economy was to empower UK-based companies to export into the rest of Europe to help their economy recover after World War I. And so it's really on the back of that that the export credit agency sector was born. And over the years, other countries have developed their own export credit agency to support the creation and growth of their domestic exporting markets. Now, again, the most important question is to say, well, we understand what an export credit agency does. They're a governmental agency and their mandate is to help develop their domestic economy. But how do they help? How do they assist? Well, export credit agencies provide something that's really, really key for any type of financing structure. They provide banks or lenders with both credit and political risk insurance. And typically that insurance is for a percentage of the financing that the bank provides. And usually it's between 90 to 100% depending on the structure. And really what the export credit agency does is they mitigate certain risks that banks take when they lend to a client. And those risks include protracted default. So for example, if the bank lends to a client and the client is unable to pay the bank back, the export credit agency takes that risk. In other words, they take the risk of the default. They also take the risk of insolvency. So if the bank lends to a client and the client ends up going insolvent, the export credit agency will indemnify the bank for that risk. The third and fourth points in that presentation are particularly important. The third point there is nationalization, expropriation, and confiscation. Now, ladies and gentlemen, it doesn't happen often, but when it does happen, the effects obviously are very detrimental to any company. Think about the following. You export something to a foreign country, and when the goods arrive at the port, they get confiscated by the local authorities. Obviously, in a situation like that, the bank's clients, the borrower, will not want to pay back their debts because they'll say, well, we haven't had free use of the goods that we bought. In this particular instance, an export credit agency will indemnify you for that risk. The fourth point is something that, again, especially in the current environment, we're hearing more and more of: currency inconvertibility and transfer restrictions. Currency inconvertibility goes without saying that it's the inability to convert one currency into another. Our business is very focused on the African continent, and when we speak to our clients, we are regularly hearing that there are instances of currency inconvertibility on the African continent. Countries like Angola, in other words, swapping out the Angolan kwanza into US dollars. Countries like Ethiopia, swapping out the Ethiopian birr into US dollars. In the current environment, this is often challenging. Also, transfer restrictions. Now, transfer restrictions is the inability for you to transfer hard currency outside of a country due to whatever reason. It could be government influence, it could be very onerous exchange control. But regardless, an export credit agency will also indemnify those risks. So moving along, how does all of this now fit in to exports? So let's set the scene. Let's say that you're a company, you're looking to export into foreign markets. How can you use export credit agency financing to your advantage? So ladies and gentlemen, we want to start by exploring the following. If you are a company, you're looking to export goods or services to another country, it could be any country on the African continent or any other country. If the value of the export contract is, say, around $20 million, in the presentation there, we've said less than 20 million, but in all honesty, export credit agency financing applies to any amount, so it really doesn't matter. Let's also say that you're looking to export in a currency that's either rands, dollars, or euro, which again are probably the three most primary trading currencies. If you are also a manufacturer or you provide services, and most importantly, the goods that you export or the services that you export constitutes no less than 50% South African content, and we'll touch on what South African content is in a minute. If your client or buyer is privately owned or a public sector enterprise, so in other words, either private or public sector, most importantly, your client must have audited financial statements. That's a particularly key point because remember, if they're looking to qualify for financing as a financial institution, you need to be able to look at the financial track record of whoever you're providing financing to. And then as I touched on earlier, if you are invoicing your clients in either rand, dollars, or euro, if any of those 6 conditions are satisfied, we have a potential solution for you. And that potential solution involves the ECRC, better known as the Export Credit Insurance Corporation. Now, for those of you that have not come across the ECRC before, to give you a little bit of background, the ECRC is South Africa's export credit agency. And South Africa's export credit agency, their mandate is to support the export of locally manufactured goods and services to other countries. And so really the ECRC is the one that would indemnify the lender against all of those risks that we touched on earlier, such as protracted default, insolvency, any type of confiscation or nationalization, as well as transfer inconvertibility or transfer restrictions. Now, what I'd like to do is I'd like to give you a real example of how the ECRC, as well as a South African financial institution, which in this case was Nedbank, was able to assist a South African company in exporting into the rest of the African continent, and in this case, specifically the country Tanzania. So during the course of last year, we had a Cape Town-based company approach us, and they said that they had landed an opportunity to export $10 million worth of transportation equipment to a privately owned company in Tanzania. The problem, however, was that the Tanzanian company could not raise $10 million of financing. Now, in this particular instance, the Cape Town-based exporter could achieve a very high level of South African content. In fact, the exact number was north of 70%. So in other words, the transportation equipment that they were looking to export had no less than 70% South African content contained therein. Now, in this case, what is South African content? Well, South African content is any type of materials or any other equipment or components that go into the final product. So if you think about transportation equipment, a big component is obviously metal and other electrical components. Well, to the extent that all of that originates from South Africa, that constitutes South African content. In this particular case, the Cape Town-based exporter also exclusively used South African labor. So all of their manufacturing and design work was all done by South Africans. All of that constitutes South African content. In other words, it's anything that originates right here in South Africa. Now, on the topic of South African content, a question that's often asked is to say, if I was to import components from, say, China, and ultimately use that in the product that I want to export to another country, does that constitute South African content? Unfortunately, the answer is no, because if the components originated from another country, and if they've just been assembled here in South Africa or have been added to something else, it doesn't constitute South African content. So what's really important to remember is that South African content constitutes anything that originates right here in South Africa. The third point is that, as I mentioned earlier, the buyer, the Tanzanian clients in this instance, was unable to raise $10 million of financing to buy the transportation equipment from the Cape Town-based company. And the reason being is that in this particular instance, the Tanzanian company had a number of Tanzanian banks that they had their banking services with. But the Tanzanian banks had very modest single obligor limits. In other words, the aggregate limit of financing that the Tanzanian banks could provide this Tanzanian company could not exceed $1 million. Obviously, in this case, the Tanzanian company was looking for $10 million. So they had to go and seek other financing structures. And fortunately, given the circumstances, Nedbank was able to assist this Tanzanian client. But we could only do so because of the support that the ECRC was able to give us. Now, let's just unpack this example a little bit more so that there's a comprehensive understanding of all the components to this financing structure. And in the presentation, I'd like to refer you to step number 1. So step number 1 is where the South African exporter enters into an export contract with the Tanzanian buyer or their client. In step number 2, Nedbank went and provided $10 million of financing to this Tanzanian-based company. But I want you to focus very specifically on step number 3. Have a look at where the proceeds of the loan have been directed. So you'll see that although Nedbank is providing $10 million of financing to the Tanzanian company, the funds get paid directly to the exporter. Now, ladies and gentlemen, that's very important for a couple of reasons. The first reason is because far too often, South African exporters have told us that despite their, say, African clients raising financing, the financing has never been used to pay them once the export has landed in the destination country. And that does often happen. So, for example, the Tanzanian company could have borrowed $10 million, but they could have used it for working capital or for some other purpose. In other words, the financing would never have been used for paying the South African exporter. But under the structure, the $10 million of financing is specific. It is bespoke to the export of the transportation equipment from South Africa to Tanzania. And in this instance, the financial institution would pay the exporter as soon as the exporter delivers the goods to the buyer and as soon as the buyer confirms their acceptance of the goods in Tanzania. So really the point that I want to stress here is that under the structure, the financing and the payment thereof to the exporter is absolutely guaranteed, because as soon as the exporter delivers the goods, the financial institution will pay the exporter directly on behalf of the buyer. Now, step number 4 is also particularly important, because in this instance, you can see that the Export Credit Insurance Corporation, so remember that's the Export Credit Agency of South Africa, they provided a policy of insurance to Nedbank. And so for the risks that we took in lending to the Tanzanian company, the ECRC indemnified us for those risks. And remember what those risks are: protracted default, insolvency of the borrower, any type of confiscation or nationalization of the exported goods, as well as any transfer restrictions or currency inconvertibility. So if any of those risks result in the Tanzanian company not paying Nedbank back the $10 million, we as Nedbank would have a claim to the ECRC. In other words, the ECRC are taking the risk in this instance. Now, if we move along, I just want to unpack really why the ECRC's involvement is so critical here. Because without the ECRC's involvement, this export would not have happened. So let's have a look at the two primary reasons why the ECRC's involvement is so key here. The first is risk mitigation. Now, we've been discussing risk mitigation throughout this presentation so far. As far as risk mitigation is concerned, as I touched on earlier, the ECRC indemnifies Nedbank against any type of non-payment risk that we would be taking in providing the exporter with the financing. Now, yes, our risks as a financial institution are indemnified, but what is the strategic importance of this to you and your business? The strategic importance is the following. Without that risk mitigation that we as the lender received, we would probably not have taken the decision to provide financing to this Tanzanian company for various reasons. However, knowing that our risks have been indemnified, we have greater appetite to provide the financing to your clients. So again, it demonstrates the fundamental importance of involving export credit agencies, because as soon as you do, banks typically have greater appetite to provide financing. And as soon as they provide financing, it means that you, the exporter, are getting paid. And that really is the key message. The second point that I want to touch on is risk transfer. Now, risk transfer is best explained using, again, a diagram. And I'd like to refer to this diagram. And as you can see, we have two parallel lines. The top line is called the risk profile, and the bottom line is the pricing. Now, let me explain how this little diagram works. If you have a look at the risk profile line, you can see that the risk profile starts from the very best risk profile. So now this is in the eyes of a bank or a financial institution. In other words, when I have a look at the risk profile of a client, you've got the very best risk profile and you've got the very worst risk profile. But obviously that risk profile is perfectly correlated with the pricing, because the very best corporate risks get the lowest pricing, the lowest interest rates. And obviously the worst risks attract higher interest rates. Now, in the case of this Tanzanian clients that we lent $10 million to, we would have put them at close to a slightly worse risk. And I won't get into the reasons why, but on that risk scale, they were obviously a slightly higher risk. Now, because of that, it means that if we were to provide them with financing, the cost of that financing would have been quite high, because obviously we are going to price for the risk that we as a financial institution are taking. However, the ECRC's risk profile is significantly better than the Tanzanian client's risk profile. And the reason why the ECRC's risk profile is significantly better is because the ECRC is ultimately backed by the South African government. And so in essence, we as a financial institution, when we get risk mitigation or a policy of insurance from the ECRC, we are effectively getting a guarantee from the South African government. Now, in this case, taking South African government risk is significantly better than taking a small Tanzanian privately owned company's risk. And so what it means, ladies and gentlemen, to cut to the point, is that on the pricing scale, it translates into better pricing for the Tanzanian clients. Because when we look at the risk profile, we're not looking so much at their risk profile, we're looking at the risk of who the ECA is, who the export credit agency is. And so at this point, I just want to pause and I want to summarize the situation so far. By involving an export credit agency, what are the positives? The bank has more appetite to lend because our risks have been mitigated. The South African exporter is guaranteed of being paid because their clients, the Tanzanian clients, has now got guaranteed financing from a financial institution. But thirdly, the Tanzanian client not only is getting the financing that they were originally looking for, but as this slide demonstrates, they're getting significantly better pricing, because this is not pricing that they would have been able to have achieved in the domestic market or any other international financing market for that matter, if the bank was purely looking at this on an unsecured basis. So if you think about it, it's win-win-win for all parties involved. The exporter is getting paid, the bank is mitigating their risks, and the buyer, your client, is getting financing on very attractive terms. Now, ladies and gentlemen, an export credit agency solution is effectively an insurance solution. And as I'm sure you've been told many, many times before, always read the fine print, because in any insurance policy, there is always fine print. So let's just unpack the fine print of an export credit agency solution. And I must admit, it's not that bad, but let's run through these points nonetheless, because they are very important. And I think these 5 points are very key to understanding how an export credit agency solution is structured. Really, the first point is that for any export credit agency structure, the buyer or the borrower, so in the previous example, that would be the Tanzanian client, they are required to make a 15% upfront payment to the exporter, meaning that under an ECA structure will only ever cover up to 85% of the value of the export contract. So for that reason, the buyer must be able to make that 15% deposit or make that 15% upfront payments. And remember, that 15% is paid directly to you, the exporter. The second point that I just want to touch on is that, as with any type of insurance or risk mitigation, the ECRC in this case do not provide risk mitigation for free. They do charge a premium like any other insurer would. And obviously, the premium that they charge is very much a function of the risk profile of the borrower. But the question that we often ask, ladies and gentlemen, is to say, the financing that we, the bank, might be able to provide the buyer with might very well be cheaper because of the involvement of an ECA. But once you add the cost of that ECRC premium on top of the cost of the financing, does it still make sense? And the answer is absolutely yes. In fact, all of our analysis has shown that the combination of the cost of the financing plus the cost of that insurance premium is still cheaper than the cost of the financing that the buyer would be able to borrow at in their domestic markets or on an unsecured basis. So even with that insurance premium, that ECA premium, the cost of the financing is still very competitive. The third point is that the seller or the exporter, so that's you, the South African exporter, you will have to demonstrate that a minimum level of South African content is achievable in whatever it is that you are exporting. And as I touched on earlier, please remember that South African content is anything that originates here in South Africa. It's got to be designed, manufactured, and produced here in South Africa. The fourth point is a very important point. It's a point that I can't stress enough. And ladies and gentlemen, that is that any export credit agency solution takes time. If you think about it, there are so many parties involved. There's an exporter, there's a buyer, there's an export credit agency, there's a financial institution. All of these parties have processes and systems and procedures that they need to go through in terms of finalizing this financing structure. So really my advice to all of you is to say that if you are considering an export credit agency structure, please do engage the appropriate export credit agency or a financial institution as early as possible, because putting these structures in place really do take time. The other point that I just want to touch on is it must be remembered that an export credit agency solution is effectively tapping into a governmental export program. And these programs do take time to put in place. So the earlier you can start the process, the better. And lastly, the banks have varying minimum deal size thresholds. So for example, you could be looking to export, say, R1 million worth of goods to a foreign country. And you could want to consider or pursue an export credit agency financing structure on behalf of your client, the buyer. Having said that though, and I do want to point this out, not all banks will find a R1 million ECA transaction very attractive, because again, the time and the effort that goes into putting an ECA financing structure in place for a very small amount is not necessarily always worthwhile the time and the effort that the banks put in. I just want to be very, very transparent on that point, because as I say, banks do have varying appetites when it comes to amounts. Some banks won't look at ECA structures unless the transaction is over $20 million, $50 million, in some cases even $100 million. So it is very, very important that you discuss that with financial institutions to just understand what their minimum deal size threshold is. Now, ladies and gentlemen, as we move towards the end of this presentation, I also want to touch on imports, because what we have focused on so far is exporting. You're a South African company, you're looking to export to another country. What solution could you tap into to enhance your exports and also ensure that you ultimately get paid at the end of the day? Well, the good news is that export credit agency financing also applies if you are importing into South Africa. So let's give you an example. Let's say that you are a company and you are looking to import a bespoke piece of equipment that you will use on a manufacturing production line, and this piece of equipment is being sourced from, say, a European country. The good news is that you could yourselves benefit from ECA financing. And let's jump into how that would be structured. So really the first point, just to again touch on it, is that if you are looking to import goods or services from a foreign country into South Africa, if you are looking to raise competitive financing at the cheapest interest rate, if you have financial statements, because remember, if you are looking to qualify for ECA financing, you will have to demonstrate your financial track record to a bank that can provide you with ECA financing. And in this instance, I think from all the discussions that we have with our clients, if you are looking to import, you obviously want to raise Rand financing, despite the fact that you could be importing a piece of equipment where you have to pay in dollars or even euro for that matter. Because if your functional currency is the South African Rand, why would you look to raise hard currency? You might as well just raise South African Rand financing to mitigate that exchange rate volatility. So as I say, the good news is that a solution does exist, and that solution could be export credit financing. Now, as we touched on earlier, it's often very, very important that you identify an export credit agency that you can work with. And what I mean by that is something which we like to call strategic importing. So let me set the scene. Let's say, for example, you want to import a piece of equipment, but it's relatively generic, and you could import it from, say, 5 different countries. What a lot of our clients are starting to now do is they are saying, of those 5 countries that we can import this piece of equipment from, which of those 5 countries has an export credit agency? And is that export credit agency generally acceptable to financial institutions? Because if all of those boxes are ticked, if that country has an export credit agency, and if that export credit agency is indeed acceptable to financial institutions, then it may very well make sense for you to import that piece of equipment from that specific country so that you can qualify for the ECA financing, as opposed to importing equipment from another country that doesn't have an export credit agency or whose export credit agency is not acceptable to a financial institution. So we like to call that strategic importing, because as I say, more and more companies are importing according to where they can get ECA financing and ECA support. And ladies and gentlemen, in this presentation and specifically on the slide, I just included 6 logos, and these 6 logos are particularly important. The logos from left to right and from top to bottom are as follows. The Export-Import Bank of the United States, which is the official export credit agency of the United States of America. UK Export Finance, goes without saying, the United Kingdom. SACI is the official export credit agency of Italy. Euler Hermes is the official export credit agency of Germany. Sinosure is the ECA of China. And BPI France is the official export credit agency of France. Now, the reason why I put these 6 logos up is because each of these 6 ECAs have appetite generally to support imports from their respective countries, exports from their respective countries into South Africa. They generally have appetite for South Africa, but most importantly, these ECAs can support South African Rand financing, which means that you could raise ECA financing in South African Rand with the support of one of these ECAs. So what I'd like to do, just to land this example further, is just to look at a diagram. This is a real example. We have obviously removed the names of the South African company and the United States exporter due to confidentiality, but still the structure remains the same. A South African company a number of years ago decided to buy specific equipment from the United States. So the US exports and the South African company entered into an export contract. Nedbank provided the South African company with South African Rand financing. And again, as soon as the US exporter delivered the goods to the South African company, Nedbank paid the US exporter on behalf of the South African company. And again, as we touched on earlier, that gave the US company certainty that they would be paid as soon as they delivered the goods to South Africa. But really, one of the most important points of this diagram is point number 4. The Export-Import Bank of the United States, the official ECA of the USA, provided Nedbank with a guarantee. And that guarantee was for all of those risks that we touched on earlier: non-payments, currency inconvertibility, etc., etc. Now, because of that, and because of the fact that US Exim is effectively an agency of the United States government, Nedbank was effectively taking US government risk in terms of providing financing to the South African company. So what I can say, ladies and gentlemen, is that the South African company raised financing on very, very attractive terms, because from a banking perspective, we were effectively pricing the transaction as if we were taking US government risk. So the South African company was able to raise South African Rand financing on very, very attractive terms. And they most certainly leveraged ECA financing to their advantage in this case. So ladies and gentlemen, that brings me to the end of the presentation. I want to thank you so much for your involvement in this morning's session. And I believe that we'll now open up for any questions or comments. If you have any questions or comments, please don't hesitate to either type them up, or Joel, maybe you can go through them one by one. So thank you very much from my side.
Absolutely. Thank you, Craig. I think that was super informative and clear. And I think lots of people on the webinar will be forwarding the recording to their colleagues to educate them as well. So thanks very much again for your time and sharing your knowledge. I've got loads of questions, but let's give priority to the ones that are asked in the chat, and I would also encourage everyone, like Craig said, to ask questions, because we do have an expert here, so this is really a good opportunity to get those questions in. Jeanette was asking, Craig, my business is South Africa and UK based. Products for export are 100% South Africa produced in South Africa. And would the ECIC be able to assist on both ends should contracts be secured?
Jeanette, so from what I understand, you are producing here in South Africa. So I think that in principle, yes, the ECIC would absolutely be able to assist you in terms of your exports into other countries. Just again, remember that if your exported goods do have sufficient South African content, and it most certainly sounds like they do, then you should be fine as far as the ECIC is concerned. From a UK perspective, what the ECIC would not be able to do is to support the export of goods from the United Kingdom to another country. But having said that, as per one of the previous slides, the United Kingdom has their own export credit agency, and that's called UK Export Finance. UK Export Finance actually is one of the oldest export credit agencies in existence. I think they were founded in 1919, as I mentioned a little while ago. So it would most certainly be worth your while to speak to UK Export Finance and see to what extent they could support you from the UK side. But that would be my advice.
Cool, thanks, Craig. We've got a question from David Shaw on the videos as well, and he's asking, what's the cost comparison, I think, of ECA Finance when you compare it with letters of credit?
Very, very good question. I have to be honest, that's never a study that we've done, but I think really the point of export credit agency financing is that because you get that risk mitigation, it crowds in liquidity, it crowds in funding. And I think that, again, in some of the discussions that we've had with our clients, very often either the exporter or the importer may not qualify for a letter of credit, whereas as soon as you involve that risk mitigation element, it just gives greater appetite. There's more interest from the banks to provide the financing because they know that their risks will be mitigated. So maybe slightly different, but I think, David, we can definitely come back to you on that point. Very good question, and I think it most certainly warrants a bit of investigating.
Awesome. Well, if any one of you wants to get hold of Craig, please just drop me a note. You definitely have my email address, so I can connect you. Walter van Aswegen is asking, we export products made in Germany to African countries. Would we be able to structure ECA finance backed by Euler Hermes, I think I have to pronounce, into Africa for our clients?
Yeah, absolutely, Walter. So indeed, if the goods that you export have sufficient German content in them, then absolutely, Euler Hermes is definitely the way to go. Euler Hermes have a very solid track record of supporting exports from Germany into the rest of the African continent. They've done numerous projects right here in South Africa and in various other African countries. So yeah, absolutely, it sounds like they would most certainly be able to support you there.
Fantastic. And then, yeah, lots of compliments also for your presentation, Craig. Maya saying, thanks for an excellent presentation. Would the ECIC premium be paid up front, or is it generally amortized?
Maya, that's a really good question. And the answer is that you can do both. So what a lot of buyers or borrowers in this instance would do, so in other words, if they are the ones raising ECIC funding, they would often insist that the ECIC premium be added to the loan amount, because what they can then do is they can amortize that cost over the term of the financing that we would provide. What that also helps with is the fact that the premium would not be a cash outflow for the borrower on day one. So again, they would be able to amortize that cost over the life of the loan. Having said that, though, there is quite a bit of discretion in that if the borrower feels it appropriate, they can also pay it annually. But also there's an element of involvement from the financial institution as well, because at the end of the day, if that premium is not paid for whatever reason, the financial institution would not be able to claim under that policy of insurance if anything went wrong. So generally from the banking side, the preference is that the cost of that premium be added to the financing amount and paid up front to allow then the borrower to amortize that cost over the life of the loan, just to ensure that it's paid and it's out of the way for the life of that loan.
Cool. Adrian is asking a long question, so I just want to do it justice. If a product is reselling another company product packaging and stationery, would stationery be local content? Yeah, basically he's asking for the definition of what is local content.
Sure.
I think that's what the question comes down to.
Absolutely. Adrian, good to hear from you again. And yes, it's the example that you've posted on the chat there is very specific, and I think we would probably just need to unpack that a little bit more. But generally, Adrian, the rule of thumb is that if you import something from another country into South Africa and you process it or modify it here in South Africa, it doesn't constitute South African content. What is South African content, though, is any of the labor or the design work that is included in the modification. So that could very well qualify for South African content because it's legitimate South African content, labor, design, and possibly materials as well. But the imported good itself would not qualify for South African content because it wasn't produced or manufactured here in South Africa.
Yeah, I think Tandiwe is asking a similar question: if cover would be provided pre-production or post-production.
Joel, sorry, could you maybe just give me the full question there?
Yeah, he says, would ECIC cover be provided pre-production or post-production? So I think it speaks again to sort of where in the value chain do you qualify, and it sort of relates probably to that a lot of stuff that's being produced in South Africa has some international ingredients, so to say.
Absolutely, absolutely. And I think it's one of the reasons why the ECIC's content requirements is not 100%. I think they fully acknowledge that, yes, South African exporters will procure certain goods and materials from foreign countries. And so it's probably worthwhile to just touch on the actual definition of South African content. It must be recalled that the actual definition is that no less than 50% South African content plus 20% local content. So in other words, that could be 20% content from the country in which the exports will be sent to give you 70% in total. So 50%, say, South African content, and then 20% of another country, or no less than 70% in total. Generally, what we advise clients is aim for 70%, because if you can achieve 70% South African content in your exports, more often than not, you will most certainly qualify for ECIC support.
Okay, that's super good advice. Thanks, Craig. And just from my side, obviously we've got a variety of people in our finance community and also on the webinar today, and the people who will be watching the replay. Does size matter? Do you require companies to be of a certain size, or are there other criteria that are size related that you have to take in account?
Yeah, it's such an important question because, as I touched on earlier, Joel, I think that it must be remembered that even if an ECA is prepared to support a transaction, it doesn't always mean that the financial institution is prepared to support the transaction. And I can give you a couple of examples. A little while ago, we were approached by a South African company that was exporting to Mali. Now, in principle, the ECIC was prepared to support the transaction. In principle, they were prepared to give very favorable terms to the buyer in Mali. However, just shortly after the inquiry landed on our desk, civil war broke out in Mali. It's one of those things. And so from a banking perspective, we would obviously very reluctant, as would any bank, to support a company in a country where there is political turmoil and, a country where there was ultimately civil war. It's a very extreme example, but really the point of the example is to show that while an ECA could very well have appetite to support a transaction, the banks still have their own policies and procedures in place in terms of which countries they can support, how much they can support. So it's always very important to not only engage ECAs, but also financial institutions to understand what their criteria are. Because really the point is this, that the involvement of an ECA does not automatically equate to financing. It's really important that you find an ECA, a financial institution, and ensure that they can work together to unlock the financing for the exports or imports in this case.
What I also found interesting in the beginning, you were sort of setting the tone about 2020, and it's a difficult year, and banks are actually focusing on their own clients more than ever before. And we're talking a lot about risk and ensuring that risk. What role does it play? Do you generally just have a much better chance to organize these things through your own bank, or is it something where you can just throw it open to wide competition? Obviously, we love Nedbank because you make these sessions possible. But in general, what is the best approach if you want to go this route?
Yeah, absolutely, Joel. So again, what we are seeing in the current environments is that banks are more willing to work with their existing client base. And so for that reason, if you are looking for ECA financing, the most natural starting point would be to approach your domestic bank and see to what extent you can arrange an ECA financing solution. So really just a little tip in terms of, you know, working with your domestic bank, working with your relationship manager, your banking manager to try and unlock an ECA structure. Most certainly mention it to your bank, mention that you're interested in exploring ECA financing to the greatest extent possible. Ask your local bank to give you some recommendations and suggestions as to how you can use ECA financing for your business, because it's often a sector of financing that is forgotten. Whereas especially in the current environment, because of COVID and because of heightened risks in emerging markets, what we are seeing is that export credit agencies are unlocking significantly more financing because banks require that additional layer of risk mitigation. So absolutely, I think really the purpose of this presentation, Joel, was to give the audience just a little introduction into ECA financing and to show some of the structures that could be unlocked. But really my recommendation would be to now take it and explore it further and see how it can work for your company and how it can benefit your company.
100%, Craig, and thank you very much. I think it's been very informative, and I think it's hopefully plays a small role into making this kind of finance a little bit less forgotten. And like I said, I'm sure we're going to share this with colleagues and share it around further, because I think it's been very instructive. So thanks to Nedbank, and thanks to yourself, Craig, again for your time and for your insights. Everyone will receive the replay in about an hour's time, and if you then have additional questions, you can just reply to that email, and I'll connect you with Craig and his team and his expertise. Maybe just good to say that this is the webinar that we were in, but we've got lots of awesome CFO South Africa Finance and Endowment Network webinars ahead of us. I think there's 3 next week, starting with Mastering Virtual Finance, around financial close and audits, sponsored by Workday. And after that, I think this is Tuesday, if I'm not mistaken. Yeah. How MasterCard optimize their back office. Quite a cool webinar with Solid Growth. Then we're going to carry on with Treasury One, ultimate automation case study. As you can see, these are all very specific and super important webinars. So please head over to cfo.co.za/events and sign up for the relevant ones and forward the other ones to your colleagues who should know about this stuff. I think there's one more. There you go. We're back with Nedbank. Shane is Craig's colleague, and he'll be talking about asset-based finance and unlocking value beyond pandemic. I've just been preparing this one with Shane. It's going to be a fantastic one on the 1st of December. So please join us for that one. Head over to the events page on the CFO website and join us again. Thanks very much, Craig. Thanks very much, everyone, for joining today.
Thank you, everybody. Have a good day.